Most traders lose money for one simple reason, and it is not because they lack intelligence, discipline, or even strategy. It is because they build the wrong habit. They train themselves to act when they should wait, to chase when they should observe, to prove themselves right when the market is quietly showing them they are wrong. And here is the strange part: the habit that made fortunes for men like Jesse Livermore was not constant action. It was not prediction. It was not finding secret indicators hidden from the crowd. It was something far less exciting and far more profitable. It was the habit of waiting for clarity. Now think about that for a moment. How often do you sit in front of a chart and feel the urge to do something? Anything. A small setup appears, price starts moving, volume picks up, and suddenly your mind begins whispering, "This might be it." You know that feeling, don't you? The hand moves toward the button before the mind has finished asking the right question. That is where most damage begins. Not in bad analysis, in rushed commitment. The market rewards patience in a way most people cannot tolerate. Why? Because patience feels like inactivity, and inactivity feels unproductive. The mind wants movement. It wants confirmation that you are involved, that you are making progress, that you are working. But trading is not paid effort. It is paid judgment, and judgment requires distance. When you learn to stand back, to truly stand back, you begin noticing what impulsive traders never see. You see hesitation at highs. You see weak rallies that look strong only on the surface. You see panic selling that is emotional, not structural. You begin reading behavior, not reacting to noise. That changes everything. Because markets are not moved by charts alone. They are moved by human behavior. Fear, greed, impatience, confidence, regret. Price is simply emotion made visible. So what habit made millions? The habit of studying behavior before committing capital. Simple words. Difficult practice. Ask yourself, when price breaks upward, what do you usually see? Opportunity, excitement, momentum. Look deeper. Who is buying? Are strong hands building positions quietly, or are late buyers rushing in emotionally after a visible move? That distinction matters more than any pattern. Because emotional buying creates weak support. Rational buying creates foundations. And foundations matter when pressure comes. The same is true on the downside. A sharp drop looks frightening, but is it true weakness or emotional liquidation? Is large money leaving, or are weak hands being forced out? Most traders look at price movement. Few ask what kind of behavior produced it. That question separates observers from gamblers. And once you build the habit of asking it, your entire relationship with trading begins to change. You stop needing constant trades. You stop forcing mediocre entries. You stop confusing motion with opportunity. Have you noticed how the best trades often feel obvious in hindsight, but strangely quiet in real time? That is because true opportunity rarely screams. It develops. Quiet accumulation, repeated defense at key levels, volume appearing where it should, failed moves in one direction followed by strength in the other. Signals begin stacking. Evidence builds. Then action becomes clear. That clarity is where conviction comes from. Not hope, not excitement, not bias. Evidence. And evidence takes time to collect. This is where the $1,000,000 habit becomes practical. Before entering any trade, train yourself to pause and ask, what is price doing? Why is it doing it? Who is trapped? Who is in control? Where would weak traders act emotionally? Where would professionals likely act deliberately? Now notice what happens. Your mind shifts from prediction to observation. That is powerful because prediction creates ego, and ego is expensive. Observation creates flexibility. Flexibility keeps you alive. Suppose price breaks resistance. Many traders buy instantly because breakout means opportunity. At least that is what they were taught. But what if volume is thin? What if price stalls immediately after breaking? What if sharp buying appears only after the breakout becomes obvious? Who is buying then? Often it is the crowd. And when crowds buy obvious strength late, professionals may quietly sell into that enthusiasm, cause an effect. Excitement creates poor timing. Poor timing creates trapped buyers. Trapped buyers create selling pressure. Selling pressure creates reversal. You see how behavior forms structure. This is what you must learn to watch. Not just where price moves, but why it moves and how participants are positioned when it does. Equally important, what should you avoid? Avoid trading from boredom. Boredom is dangerous because it disguises itself as analysis. You start inventing setups simply because nothing meaningful is happening. Avoid revenge decisions. A wounded ego seeks quick recovery, but rushed recovery usually deepens loss. Avoid oversized conviction built on thin evidence. Strong opinions with weak confirmation destroy accounts. And avoid one more thing. This may be the hardest. Avoid needing the market to validate you. Can you sit out for days if conditions are unclear? Can you watch a move happen without you and remain calm? Can you admit, quickly and cleanly, that your read was wrong? That is maturity in trading, not brilliance, not complexity. Maturity, because the market is not testing your intelligence. It is testing your emotional habits. Every decision reinforces identity. Impulsive entries reinforce impulsive behavior. Careful observation reinforces careful judgment. Repeated patience becomes instinct. And instinct, built correctly, becomes edge. This is how fortunes are quietly built. Not through dramatic wins, but through repeated alignment between clear observation and disciplined action. One habit: observe deeply, act selectively. Observe deeply, act selectively. The words are simple, but inside them is a lifetime of mastery. And once that habit takes root, something unexpected begins to happen. You stop feeling hunted by the market. You stop reacting to every candle. You begin sensing rhythm, the push, the exhaustion, the hesitation, the false confidence, the silent strength beneath visible weakness. You become less emotional because your process becomes stronger than your impulses. And then, on certain days, a setup appears with unusual clarity. Everything lines up. Behavior confirms structure. Volume confirms behavior. Timing confirms opportunity. At that moment, hesitation is no longer wisdom. It becomes missed opportunity. And that is the hidden balance few traders ever understand. Wait with patience. Strike with conviction. Then return to patience. Most people reverse that order. They act constantly, hesitate at the right moment, then force trades to make up for hesitation. That cycle keeps them trapped. Most traders are taught to believe that money is made by knowing what comes next. They spend years trying to predict the next breakout, the next reversal, the next sudden move that everyone else will miss. They search for certainty in uncertain ground, thinking that if they can just become accurate enough, profits will follow naturally. But markets do not consistently reward prediction. They reward patience. That may sound strange at first. After all, if trading is about buying before price rises and selling before price falls, does that not require prediction? Not quite. It requires observation strong enough to reveal probability, and patience strong enough to wait until probability leans clearly in your favor. There is a difference. A trader obsessed with prediction is always early. He sees what might happen and commits capital before the market has confirmed anything. His mind fills in gaps that price has not yet filled. He becomes attached to an idea, and once attachment forms, judgment weakens. Have you noticed how quickly conviction appears when money is involved? A small position becomes a strong opinion. A strong opinion becomes stubbornness. Stubbornness becomes loss. Not because the market was impossible to understand, but because impatience entered before clarity arrived. Patient traders think differently. They do not ask, what will happen next? They ask, what is happening now and what does it suggest? That question changes everything. Instead of forcing a forecast, they wait for behavior to reveal itself. They watch how price reacts at important levels. They study whether strength follows buying or whether buying quickly fades. They notice if weakness accelerates naturally or if sellers suddenly lose control. These are not predictions. These are observations. And observation repeated with patience creates informed action. Think about how often markets create false excitement. Price breaks upward, momentum builds, traders rush in, and for a moment everything appears strong. Then buying dries up, price stalls, the breakout fails. What looked like opportunity was simply emotional participation arriving late. Why do so many get trapped there? Because excitement is fast and patience is slow. Most people trust what feels urgent. Professionals trust what proves itself over time. That is where patience begins to outpay prediction. Patience allows evidence to build. Evidence creates conviction. Conviction built on evidence produces better decisions. better decisions, repeated consistently, shape long-term results. Because leads to effect. But patience does something deeper. It protects capital. Every unnecessary trade carries hidden cost. Not just money lost, but emotional energy spent, confidence shaken, focus divided. A trader who acts too often slowly weakens his own judgment. He becomes reactive, and reactive minds see noise as signal. Patience filters noise. It forces selectivity. It keeps you out of mediocre trades so your capital is available for exceptional ones. Can you sit still when nothing clear is happening? Can you watch movement without feeling the need to participate? Can you let opportunity come to you instead of chasing it? That is harder than analysis. That is discipline. And discipline is where patience becomes profitable. The market moves every day, but real opportunity does not. This is what many fail to understand. Constant movement creates the illusion of constant opportunity, but most movement is random conflict. Buyers and sellers pushing price without meaningful imbalance. Entering during that noise is like speaking in a crowded room and expecting clear conversation. Patience waits for silence in the noise. Then meaning becomes visible. You begin noticing clean structure, repeated support, failed selling pressure, genuine momentum backed by commitment rather than emotion. And when those pieces align, action becomes simple, almost obvious. Not because you predicted perfectly, because you waited long enough to see clearly. That is why patience outpays prediction. Prediction tries to control uncertainty. Patience learns to work with it. One fights the market's nature. Most traders stare at charts and believe they are reading the market. In truth, they are often only reading lines, candles, and patterns without understanding the people behind them. They focus on shape while missing behavior. They study movement while ignoring motive. And that is where their understanding stops short. The chart is not the market. The chart is a record of human decisions. Every rise carries optimism, urgency, greed, or confidence. Every sharp fall carries fear, panic, forced selling, or exhaustion. Every period of quiet movement reflects hesitation, balance, or hidden accumulation. Price is simply behavior made visible. Once you understand that, the chart begins to speak differently. You stop asking, where is price going? You begin asking, who is acting, and why are they acting now? That question changes what you see. Consider a strong rally. At first glance, it looks bullish. Most traders see green candles and think demand is strong. They chase price upward because movement itself creates belief. But look closer. Is buying steady and deliberate, or sudden and emotional? Is volume supporting the move, or is price climbing on weak participation? Are pullbacks shallow because buyers are committed, or is price moving too fast because late traders are rushing in? Who is in control, strong hands or emotional hands? That distinction matters. Emotional buying is unstable. It burns bright then fades quickly. Strong buying builds structure. It supports price, absorbs pressure, and creates continuation. The crowd often mistakes excitement for strength. Experienced traders do not. The same applies when markets fall. A fast decline looks dangerous, but panic can create false weakness. Retail traders see sharp selling and assume collapse is coming. Fear spreads quickly because human beings react strongly to visible pain. Selling becomes emotional, not rational. Stops get triggered. Weak hands exit. Pressure builds. But beneath that pressure, strong money may be quietly absorbing supply. Can you recognize that? Most cannot, because they are watching candles, not behavior. That is why crowds repeatedly enter too late and exit too late. They buy after confidence becomes obvious. They sell after fear becomes unbearable. Their decisions are emotional echoes of what already happened. Professionals watch those reactions carefully. Crowd behavior creates opportunity because crowds behave predictably. They chase strength late. They panic at weakness late. They seek certainty after moves are already extended. They confuse public emotion with market truth. This is why reading the crowd matters more than reading the chart alone. The chart tells you what happened. The crowd tells you why it happened. And when you understand why, you begin seeing what may happen next with clearer judgment. Not through prediction, but through understanding behavior. Watch how traders react near important levels. Does resistance create hesitation, or do buyers confidently push through? Does selling pressure increase sharply, or is weakness absorbed quickly? Does bad news create collapse? Or does price remain strangely firm? Reaction reveals positioning. Positioning reveals vulnerability. Vulnerability reveals opportunity. Cause and effect. That is the hidden rhythm beneath market movement. You are not studying candles. You are studying confidence, fear, greed, hesitation, and urgency appearing through price. When confidence becomes reckless, caution becomes valuable. When fear becomes extreme, opportunity often begins quietly. When movement becomes obvious, risk usually rises. When behavior becomes subtle, information often improves. So when you look at a chart, ask a better question. What is the crowd feeling that price is revealing? The biggest moves in the market rarely begin with noise. They begin quietly. That is what makes them invisible to most traders. People are trained to notice excitement, sharp rallies, sudden breakouts, heavy volume, fast movement. Their eyes are drawn to what looks dramatic because drama feels important. Motion creates attention. Attention creates belief. Belief creates participation. But by the time the crowd notices, much of the opportunity has often already taken shape beneath the surface. Big money does not move loudly at first. It cannot. Large positions are built carefully, often over time, because aggressive buying or selling reveals intent too early. Strong hands prefer quiet entry. They accumulate while price appears dull. They build positions while retail traders complain that nothing is happening. They act when the market feels boring, balanced, and unnoticed. That quiet behavior leaves clues. Not obvious clues, subtle ones. And subtle signals are where serious traders learn to focus. Have you ever noticed a stock refusing to fall despite repeated selling? That matters. Have you seen price hold firm while the broader market weakens? That matters. Have you watched volume slowly rise over several sessions without dramatic movement? That matters. These quiet details often reveal hidden strength before visible strength arrives. The same is true in weakness. Sometimes price stops rising, but it does not collapse. Instead, rallies begin fading sooner. Volume appears on down moves but dries up on recoveries. Support levels are tested repeatedly. Buyers defend price, but with less conviction each time. At first glance, nothing dramatic is happening. But beneath the surface, control is shifting. That shift is information. Most traders miss it because they are waiting for obvious confirmation. They want large candles, explosive volume, and unmistakable momentum. They trust loud signals because loud signals feel safe, but loud signals attract crowds. Crowds create poor entries. Poor entries increase risk. Quiet signals appear before emotional participation begins. That is where advantage often lies. This requires a different kind of observation. Instead of asking, what is moving fast? Ask, what is quietly behaving differently? That question opens new eyes. Look for unusual stability and weakness. Look for repeated defense of key levels. Look for price compressing into tighter ranges while volume slowly builds. Look for failed breakdowns that quickly reverse. Look for rallies that hold gains instead of giving them back immediately. Behavior speaks before price shouts. Markets whisper first. Then they speak. Then they roar. Most traders only hear the roar. By then, emotion is everywhere. Late buyers rush in. Headlines become optimistic. Confidence spreads quickly. What began as quiet accumulation becomes public excitement. And public excitement usually carries worse risk than quiet preparation. The patient trader learns to listen earlier. He watches what others dismiss. He studies what appears ordinary. He pays attention to what does not make headlines. Because strength often hides before it reveals itself. Weakness does the same. A market topping out rarely announces its peak loudly at first. It often begins with quiet exhaustion, less momentum, weaker follow through, failed pushes higher, increasing hesitation beneath surface optimism. Everything still looks healthy, but behavior is changing, and behavior changes before narrative changes. That is the edge hidden in quiet signals. You are not looking for excitement. You are looking for quiet change that eventually becomes impossible to ignore. Most traders think discipline means knowing when to act. Few understand that real discipline is knowing when not to. That sounds simple, but in trading, doing nothing can feel harder than making a decision. Sitting still while price moves tests the mind in ways constant action does not. You begin feeling left out. You feel as though opportunity is slipping away. Every candle starts looking like a setup. Every move feels like something you should be involved in. And that feeling becomes dangerous, because the urge to act is often emotional, not rational. Have you noticed how quickly boredom turns into false confidence? A trader watches the screen long enough, and suddenly patterns begin appearing everywhere. Small moves start looking meaningful. Weak setups begin feeling good enough. The mind starts convincing itself that action is necessary simply because inactivity feels uncomfortable. That is not analysis. That is impatience dressed as logic. The market does not reward your need to participate. It rewards timing, judgment, and selectivity. And selectivity requires restraint. This is where doing nothing becomes powerful. When you refuse mediocre trades, you protect more than capital. You protect clarity. You protect emotional balance. You protect confidence from unnecessary damage. Every poor trade creates friction in the mind. Doubt after a loss, frustration after a missed exit, emotional pressure to recover quickly. One bad trade often creates the next. Cause and effect. Forced action leads to weak judgment. Weak judgment leads to avoidable loss. Avoidable loss creates emotional reaction. Emotional reaction creates reckless behavior, and reckless behavior compounds damage faster than bad analysis ever could. Doing nothing breaks that cycle. It keeps you untouched by noise. It allows you to remain objective while others become emotional. Think about how many market moves begin with chaos. Sharp spikes, sudden reversals, confusing volatility, conflicting signals. In those moments, traders feel urgency. They believe speed is required. They think hesitation means missing out. But often, confusion is exactly when patience has the greatest value. Why step into uncertainty when clarity usually comes later? Why trade movement when structure has not formed? Why commit money before evidence is gathered? These are hard questions because the mind wants immediate engagement. Stillness feels unnatural. But stillness sharpens observation. When you are not rushing to enter, you begin noticing details others miss. You see where buyers hesitate. You see where selling pressure fades. You notice failed breakouts, weak recoveries, hidden support, unusual resilience, subtle exhaustion. You start reading behavior more clearly because your judgment is no longer clouded by the need to act. That is a hidden edge. Markets create endless temptation, but true opportunity is selective. Not every day offers it. Not every move deserves attention. Not every setup deserves capital. Can you accept that? Can you watch a market move without feeling compelled to chase it? Can you let a trade go because it does not fully meet your standard? That restraint separates serious traders from emotional participants. Professionals understand that cash is also a position. Waiting is also a decision. Doing nothing is often active discipline, not passive avoidance. Because in trading, preserving capital is not separate from making money. It is what makes future profits possible. The trader who constantly spends emotional and financial capital on weak opportunities becomes fragile. The trader who waits becomes stronger, sharper, and more prepared when real opportunity appears. Then, when the right moment comes, action becomes clean, clear, decisive, because patience prepared the mind for that moment. Sometimes the smartest move in the market is no move at all. Impulse is expensive in ways most traders do not fully understand. They think impulse costs money because of bad entries or poorly timed exits. That is true, but the deeper cost is much greater. Impulse damages judgment. It weakens discipline. It trains the mind to react emotionally instead of thinking clearly. And once reaction becomes habit, losses begin repeating through behavior, not strategy. That is why many traders keep making the same mistake in different forms. The chart changes. The setup changes. The market changes. But the emotional pattern stays the same. A sudden move appears, excitement rises, and the trader feels pressure to act quickly. Not because the opportunity is clear, but because movement creates urgency. Fast price action makes the mind believe speed is necessary. It creates fear of missing out. It creates the illusion that hesitation means losing opportunity. Have you noticed how impulse often feels like certainty in the moment? That is what makes it dangerous. The emotional mind is convincing. It tells you this setup is obvious. It tells you this breakout is strong. It tells you this dip is the perfect entry. It creates confidence before evidence has formed. Then reality arrives. Price stalls. Momentum fades. The move reverses. And suddenly what felt clear becomes confusion. Impulse enters fast. Regret follows slowly. This is how expensive habits are built. One impulsive trade may seem harmless, but repeated impulsive decisions quietly shape identity. You stop becoming a trader who observes and starts becoming a trader who reacts. You begin chasing movement, forcing entries, exiting too early from fear, holding too long from hope. Emotion starts controlling timing, and timing is everything. Poor timing creates weak entries. Weak entries create pressure. Pressure creates emotional exits. Emotional exits create frustration. Frustration creates revenge trades, cause leads to effect and the cycle deepens. Soon the trader is no longer responding to the market. He is responding to his own emotions. That is a dangerous place to operate. Impulse also blinds observation. When the mind is rushing, it stops seeing clearly. It ignores warning signs. It overlooks weak volume. It dismisses hesitation near resistance. It fails to notice that price is extended, that sentiment is crowded, that risk is rising while reward is shrinking. Why? Because impulse narrows focus. It sees only what supports action. It filters out what suggests caution. That selective vision becomes costly. The calm trader sees more because he feels less urgency. He does not need every move. He does not confuse speed with opportunity. He understands that markets are full of traps designed by emotion. Fear traps, greed traps, impatience traps, and impulse walks directly into them. Can you pause when excitement rises? Can you sit with the urge to act without obeying it? Can you separate emotional pressure from genuine opportunity? That is where discipline becomes real. Not when markets are quiet. When emotion is loud, the strongest traders are not emotionless. They simply refuse to let emotion make decisions for them. They feel excitement but wait for confirmation. They feel fear but still follow evidence. They feel urgency but trust patience more than instinct. That is controlled behavior, and controlled behavior protects capital. Over time, restraint becomes habit. The mind slows down. Observation improves. Entries become cleaner. Exits become more rational. Trading becomes less emotional because decisions become less impulsive. Then the market begins looking different, not like a series of urgent opportunities, but like a place where impatience pays tuition and patience quietly collects it. Most traders enter a trade because they feel something. A chart looks strong. Momentum appears fast. A setup resembles one that worked before. Confidence rises, and without realizing it, they act on excitement more than evidence. That is where trouble begins. Excitement feels powerful because it creates certainty. It gives the mind a sense of conviction, even when that conviction has little foundation. A fast-moving market makes people believe opportunity is obvious. A sharp breakout creates urgency. A quick drop creates fear of missing the reversal. Emotion builds a story, and that story becomes action. But markets do not care how convincing a feeling seems. They respond to pressure, positioning, liquidity, and behavior. Feelings are fast. Evidence takes time. That difference separates emotional trading from intelligent trading. Have you ever noticed how many trades look perfect right before they fail? That is often because traders confuse visible movement with confirmed strength. Price pushes higher, volume increases, and confidence spreads quickly. It feels like confirmation, but look deeper. Is buying broad and committed, or is it sudden and emotional? Is price holding gains or stalling immediately after rising? Are pullbacks shallow and healthy, or sharp and unstable? These details matter. They are evidence, and evidence tells the truth that excitement often hides. The patient trader waits for proof, not proof that a move exists, proof that the move has substance behind it. There is a difference. Anyone can see movement. Few study what supports movement. Strong trades usually leave footprints. Price respects important levels. Volume appears where it should. Momentum follows through instead of fading quickly. Buyers defend pullbacks with conviction. Sellers fail repeatedly to push lower. Weakness gets absorbed instead of accelerating. Signals begin stacking. One clue alone means little. Several clues together create weight. That weight is evidence, and evidence creates confidence that is calm, not emotional. Excitement shouts. Evidence speaks quietly. Excitement demands speed. Evidence rewards patience. Excitement makes traders chase. Evidence helps traders select.